BlackRock has launched a new range of funds called MyMap, and these are going head-to-head against Vanguard's LifeStrategy funds, but for a lower fee. Now, the approach to asset allocation, which is how much money you put into shares and bonds, is quite different when you compare the two. So to see what's on offer from MyMap and to compare it with Vanguard, let's see that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start by finding out who BlackRock is. Although you may not be familiar with BlackRock, you've almost certainly heard of iShares exchange-traded funds. iShares was one of the first companies to issue ETFs, and it's very well established in this market. But as you can see from its annual report, it also produces a suite of other products for cash management, target date funds, and factor funds. BlackRock is the largest asset manager on the planet, and they have $6 trillion of assets under management. Passive indexing products are their major focus. iShares makes up about a third of their funds, with another third in passive index products which aren't ETFs, but there's also a third in active funds. About half of that money is equity funds, with about a third in fixed income. And the topic of this video is MyMap funds, which fall into the multi-asset category. And these are funds that contain a mixture of different asset types, including shares, bonds, but also real estate. To put the size of BlackRock's assets under management in perspective, we could take that $6 trillion and compress it into a single asteroid, or perhaps we should call it a cashsteroid. Using figures from Rhett Allen's amazing .physics article in Wired, I calculate that BlackRock's $6 trillion would make a cashsteroid about 218 meters in diameter. In fact, it's so large that that mass of cash would generate a significant gravitational field. How does that compare with Vanguard? Well, Vanguard is also an asset manager, and its assets under management are a mere $5.2 trillion. Vanguard's focus is also passive funds, although it does have some active funds too, and it has an almost religious dedication to low expense ratios, thanks to the beliefs of its founder, Jack Bogle. And if we were to compare cashsteroids, Vanguard's would just be 208 meters in diameter versus the 218 for BlackRock. However, there is a significant difference in the governance of Vanguard, which is that in the US, Vanguard investors are the actual owners of the company. And that means that Vanguard doesn't have to siphon off profits to shareholders and investors. And consequently, clients keep more of the returns that each fund earns. It's not just about the size of the funds. Both companies have simply hoovered up cash over the last few years. This shows the change in the size of the fund, in other words, the inflows and the outflows of cash since 2015. And you can see that Vanguard and BlackRock iShares have simply dominated inflows. While other firms have been losing money, and those you can see in orange as large outflows, Vanguard and iShares have had very low fees, which has attracted cash into their funds. Now let's look at the MyMap funds in detail. Firstly, they're long-only funds. This means they can only buy assets, they can't sell assets which they don't own. Secondly, they're based in the UK, so they're UK domiciled and denominated in sterling. And finally, they're risk graded, so there are 4 profiles sorted by risk. And for some reason, the indexing starts at 3. So we start with MyMap 3, which is 3% to 6% volatility. Then as we increase the risk by increasing the amount of stocks in the fund, the risk increases to 10 to 15% volatility for MyMap 6. And the fees for all 4 funds are 0.17%, which is deliberately meant to undercut Vanguard's 0.22% for its LifeStrategy funds. Here's BlackRock's description of MyMap. The primary difference with LifeStrategy is that MyMap is actively managed, whereas Vanguard LifeStrategy funds have a fixed allocation, and if you look at the manager field here in ShareScope, you'll see it's not disclosed because it's simply not relevant, although there is a committee which decides on the allocations and reviews it on an annual basis, whereas MyMap is designed to be actively managed by Rafael Iborra and John Wang, and its allocation will change over time to reflect the market views of those 2 portfolio managers. MyMap is a total return fund, and what that means is that it's not tied to any particular benchmark. For example, if you look at this iShares MSCI World ETF, and here you can see its returns in green, it's designed to track the MSCI World Index as closely as possible. And you can see it does so. It's very close to the blue line for MSCI World. But MyMap can go completely off-piste. The asset managers have a lot more leeway, a lot more freedom to change the allocations. The constraint that they do have, as we've seen, is the risk profile of the funds. Now, these volatility targets are quite different from the way that LifeStrategy manages its risk profiles. For LifeStrategy, it's the allocation which determines the risk. So you choose a fund according to its equity allocation, ranging from 20% to 100% equity. From experience, I know that it's much harder to teach people about volatility than it is to teach them about allocation. Volatility simply scares people. If we look at how the MyMap volatilities compare to LifeStrategy funds, MyMap 3 would fall somewhere between LifeStrategy 20% equity and 40% equity. And the volatility of MyMap 6 falls just below LifeStrategy 100%. The diagram on the left shows the MyMap asset allocation. That's how much money is put into each different asset type, ranging from fixed income on the left, which is in corporate and government bonds, to equity on the right, which is put into international stocks, emerging market stocks, particular sectors and factor funds. But there's also leeway to put money into alternatives and into themes. That leaves a lot of wiggle room, whereas if you look at Vanguard's LifeStrategy 60% allocation on the right, it's fixed. You know exactly what you're going to get, and it's very simple. And it's not immediately obvious which is going to be better, the active management on the left or the simple fixed allocation on the right. In fact, this isn't the first time that BlackRock has created multi-asset funds, which compete head-to-head with Vanguard LifeStrategy funds. BlackRock's consensus funds try to do exactly the same thing. The consensus funds invested in cheap BlackRock passive funds, which allowed them to keep their management fee low. Consensus funds were diversified across different regions and across different asset types, and just as with MyMap funds, they were actively managed. Instead of having a fixed allocation to equity and bonds, they set an upper limit to how much they could put into equity. So for example, Consensus 35 could invest no more than 35% of the fund in equity, and that limited the risk of the fund. And Consensus had 5 of these risk-graded funds, ranging from 35 all the way up to 100. In this diagram, BlackRock tries to show the relationship between risk and return, with the potential for greatest return coming from Consensus 100, which is completely allocated in equity. BlackRock considered the active management of consensus funds to be a selling point. They were managed by the Index Asset Allocation team in the ETF and Index Investments group. And it clearly thinks that the MyMap fund's active management is also a selling point, which in this case is going to be done by the experienced multi-asset team. And it's not clear whether that's the same team as manages the consensus funds. If we look at the performance of the consensus funds between 2012 and 2019 and compare it with LifeStrategy funds, the returns have lagged those of comparable LifeStrategy funds. So for the same level of risk, LifeStrategy funds have offered a considerably greater return. But a 7-year comparison period maybe isn't fair. One should really look over a longer investment horizon to see the benefits of active management or the drawbacks of active management. So to summarize, the low fees for BlackRock MyMap funds are fantastic. 0.17% per year for a multi-asset fund is extremely competitive. And as each of these cheap multi-asset funds comes out, it's going to drive competition elsewhere and hopefully drive expensive and underperforming multi-asset funds out of business. Vanguard LifeStrategy funds are also very cheap, but no longer the cheapest in its category. But in their favour, LifeStrategy is very well established and it has a history of good performance versus other multi-asset funds. Also, people tend to find this fixed allocation a very simple concept to understand. The drawbacks with BlackRock are obviously that it has no track record because it's just been launched in the summer of 2019. Sorting by volatility may be difficult for some people to understand, and the fact that allocation is dynamic depending on market conditions and active management may also be difficult to understand for some of the investors. And this flexibility could itself be considered a danger if the fund managers get it wrong. LifeStrategy funds also have their drawbacks. For example, they can't invest in factor funds or in real estate investment trusts, which would provide extra diversification and tends to provide high income. LifeStrategy also has a very large US allocation, particularly the funds which have a high percentage of equity. But that simply reflects the fact that US markets are so big, and LifeStrategy funds are weighted according to the size of the market, with an overweight for the domestic market. And although the fixed allocation is easy to understand for investors, it may not necessarily be a smart thing to do. Having a fixed allocation in all market conditions is a pretty dumb approach to asset allocation. So it's pretty difficult to compare the two sets of funds because there just isn't much track record for MyMap yet. But we can make a comparison with consensus funds, and there the comparison doesn't look so good, but still it could outperform. If you want to join our online community and ask questions anytime you like, including ones on Slack, which I answer at almost any time of day or night, then you just have to pay $5 on Patreon. And in pounds, that's about £5 when you include VAT per month. So that's a very small amount of money for something which will give you a lot of benefit. Plus you can learn about investment from other people in the community, which is very helpful. And we have a call on Sunday evenings, which you can take part in and suggest questions for. And that's at 8 p.m. So if you want to join us, just click on the links for Patreon and we'd love to see you on that call. And as always, thank you for listening.